All right, we're back. Another episode of Jack of All Trades. Today's episode, we're gonna share some information with you guys on a little company called USO, kind of a rather large fund, and its price correlation with the actual crude futures price. We're gonna track a little bit of that. We're gonna show you some graphs. We're gonna show you uh, some spreadsheet work that Jack has put together for us. If you want to refer back to our podcast, we put one out this morning regarding this topic. Just a little behind the scenes look at what we're going to do today. So, Jack, we've had some time to take a little closer look at this. Well, let's share some of the things that we found with the viewers here today. What are we looking at as far as the spreadsheet and the graph numbers here?
All right. Well, can you see my screen now?
Yes, sir.
Okay. So, this is, this isn't personal, but this is just something from the news. And, I follow commodities and trading and futures and whatnot and have a lot of experience in that. And I've always been just a little skeptical of anybody trading futures that doesn't, that don't speculating on futures is a pretty dangerous business that, I don't feel a lot of people should be in. And then I see these ETFs and they're built around, people wanting to speculate on the price of oil, which is already really dangerous. And so, and they have plenty of disclaimers and I'm fine with all that. And anybody can do what they want to do, but when I saw all this going down with USO, it really got my attention because it just seemed like crazy. It seemed crazy that they were losing so much more value than had they had crude futures. So, what I looked into a little bit was just like what. Sorry to keep flipping the screens here. USO's investment objective and strategy, and it's just I'll read it here. You can look it up, but it's their prospectus summary that they put out February of 2018, and it's for the daily changes in percentage terms of its shares, per share net asset value, so the value of the company based on what percent you are of the company, for the percent of that to reflect the daily changes in percentage terms of the spot price crude, which they define as the front month, short-term futures contract on light sweet crude. So if I go here, as you can see this chart, this goes back a year.
Okay.
And so as you can see, the red is crude oil front month at NYMEX here. I've got that. And then the blue line is the USO, US Oil Fund. Now this is post reverse split, and that's the reverse split is something we'll talk about at the end here. So as you can see, this blue line is like on top of the red line, almost. I mean, lockstep, and here, they deviate just slightly. So, I would say, yeah, they if you think their stated goal is a useful goal, well, then they were achieving their goal during these time periods. Even as crude fell off the table, they stayed kind of right with it. And then as it really started in April, somewhere here around so the 21st is when we went negative. And as you can see right here, it just completely ripped apart here, where when crude recovered, from 15 to 20, or from 15 to 26, the stock price hasn't hardly recovered at all.
Right. So I see it's a very highly correlated. I mean, as far as things go for most of the year, then obviously we have this huge decoupling here. And it looks like it might just be the start of this might be just the start of it, right? So if we take a look at a little bit closer at the numbers that you have on the spreadsheet over here, maybe this can help explain a little bit of what's going on with this decoupling here.
Okay, so yeah, the decoupling is it happens here. And what I did here is I just took the stock price on the left. Let's hide. This is the pre-split price. So now if I use everything post-split on this left column here, can you see that column
Yeah.
C? This is stock price, and the right-hand side is the crude oil price. So
Okay.
let's just leave history out of it and just start from the beginning of the year. And you know, these are the changes in price from month to month, right? So this is 5 months. And then what I did here was a percent. So when in February, down 20%, down 18%. So it's only a 2% difference. Then they were both down 6% in March, same, in April or through to March. And then the month of March, it just got crushed 56, but 56 and 57%. So it hung in there. But in April, the month of April, the stock is down 46%, and the oil and just the crude futures are only down 3%. And that is that massive decoupling that we're talking about. That's on the graph over here that basically shows on May 1st. And to me, that's just right there. I would just say their stated goal is completely blown out of the water. Like that's 46%. So their stated goal of tracking it is to me, it's so far out of bounds. I don't know. I personally don't know what the point is of going on as a company after that.
It certainly seems like it's going to be hard to recover after something like this, especially and I don't know as much about it as I probably should, but the reverse stock split that you mentioned previously, what's the impact that now has moving forward? Let's say if I'm a shareholder, what am I looking at with this it's 8-1, I think, reverse stock split? What am I looking at now?
Right. So and this is what's problematic about that is that now you if you now you have eight less, you have one share for every 8 shares. So on the way back up, if they're in essence they're trying to remain, tracking the price of oil. So anybody who comes in now has got kind of the same thing when they, if anyone who not comes in, but anyone who buys the stock today at 21.40, can maybe expect that same type of correlation. But the problem is if oil goes back up to where it started the year at $60 and the shares go along at the same rate, well, then they're going to be like $50 or whatever that equates to, because right now it's 21 for the stock and 25 for crude oil. Then your stock price is only going to be like $55, and you're going to be out on $105 stock purchase at the beginning of the year. You're going to be out almost 50% when the price of oil is going to be breaking even. And that's because your leverage now is so far, behind, because now if it goes up the same percentage, I guess the easiest way to explain it is now the stock tracking it percent wise, you are only getting 12.5% as a stockholder from your original stock. You're just, if the stock tracks it equally percentage, your investment is only going to come back 12.5%, which is in essence, you just took on this debacle, you just got frozen out of 87.5% of your original investment, roughly speaking.
Wow. I mean, wow. I don't know that's almost, I don't know how you're going to be able to recover from something like that. I don't know. Maybe you just, I don't know. Hope and pray.
What I mean is, I don't think you can recover. And what I just don't understand why they're allowed to do this. Like it's. I mean, yeah, if you look at their prospectus summary and it's got their objective and strategy, and that is to track it. Well, they completely failed in it. And so I don't know why, because they put in all these disclaimers of risk factors, correlation risk, tax, whatever, and it's like to cover themselves on all this, and that's fine, but it like, I don't know how they can fail so hard at what they did and then just like press the reset button. I would at least, and here's why they do it. Okay, so they cannot, there's different rules for it. And I can't speak to exactly what drove their reasonings, but there are, for value, they can't maintain, they can't keep going on if their share value is not at a certain level. So they need to boost the share value to qualify, under certain guidelines. And I don't pretend to be, an expert on that, but the bottom line is they got knocked out because they didn't understand the risk, the risk of these calendar spreads and rolling these prices. And so when they had to roll out of their front month into the next month, like they always do, the prices were so, large that they just spent a lot of money to just maintain the same position. They spread from June to August for $9, and that it's when the crude was trading $14, and that's just it just locked into such a huge greater price. But when they do that, that's all fine if they can, if they can gain that same kind of leverage on the way back up. But as a stockholder, when you've lost 87% of your leverage, there's nowhere that crude can realistically go to get your money back. I mean, I would just say I would say that money's gone, and I would say now that they're trying to do the same thing, they're just going to line up a whole bunch of unsuspecting people to come in and put themselves in that same position, to get to lose 87% of their money.
Wow, interesting strategy. I'm sure we could do an entire episode on, the rules and the regulations and all this disclaimers and this and that behind the scenes type stuff. But the point of our show, Jack of All Trades, is to bring you some value to a broad range of topics that we tend to follow closely, a little more closely than others. Not experts in anything what we do, but to try to interact and engage with our listeners. So feel free to reach out to us on Twitter at Jack Viking for Jack Newman, at First Gator for me, Gates Haug. And thanks for tuning in to this episode of Jack of All Trades. And be sure to tune in next time.